My mission with the Mortgage Report is simple: to save you money. I'm here to provide weekly insight into the market so you can make the best buying decision. I want you to know where interest rates are headed, and I promise to let you know my lock or float position. The Mortgage Report starts now. Hey everybody, I'm Bob Johnson, aka Bob Mortgage. Welcome to the Mortgage Report. I do this video update every week so you know what's going on in the market and to help you make decisions as it relates to interest rates, so you know what to expect as you're out there shopping for a home. If you're in the market to buy a home and want to explore loan options and interest rates, give me a call at 214-631-5626 or tweet me at Bob N. Johnson. All right, let's jump right into this week's Mortgage Report. Last week, I took a short position for Monday and Tuesday as I felt there was still some volatility left out there from the previous week. On Monday, the bond market opened in positive territory to start the week, then quickly erased all the gains. By Tuesday, we saw a slight uptick in interest rates. The slide continued on Wednesday as the bond market opened in negative territory, about 18 basis points as the Dow hit the 20,000 mark. We closed the week stronger, mostly due to missed expectations around durable goods and the GDP number. The 10-year is trading between the 230 and 250 mark, the two green dotted lines in my chart. If we can break through the 230 mark, we could see a nice downward trend, which would help mortgage-backed securities, resulting in an interest rate improvement. If we break through the 250 mark, that would result in a run-up, and we could see interest rates rise as a result. Our analysts are forecasting a trading range for the 10-year bond between 2.25 and 2.5 for most of the year. If that holds true, even though we're in a bit of a downward trend, we should move sideways between the red line and green line in my chart. Now, that doesn't mean we can't get a rally and push us up over the 103 mark, especially if we see a pullback in the stock market. It's just the reality we need to get used to. That means 30-year interest rates with sideways bond movement should hold between 4 and 4.5 for most of the year. This week is an extremely important and busy week for the financial and mortgage markets. It's packed with data, some being key major reports, and we also have our first FOMC meeting of the new year. The Federal Open Market Committee, the FOMC, is the branch of the Federal Reserve Board that determines direction of monetary policy. So I'd say we have a pretty busy week. Before this week's release though, Ryan Stewart, a senior economist at Moody's Analytics, said the strong job market and optimism among consumers and companies for President Donald Trump's policies are likely to keep growth humming along in 2017. The economy has a strong underlying fundamentals. Growth should accelerate this year. So with all that said, what's my position this week on interest rates? In the short term, the next 1 to 2 day locks, I'm taking a long position as I anticipate pricing could improve, which would lead to lower rates. For the long term, 30+ day locks, I'm taking a neutral position as I expect the market should stay close to open, plus or minus about 25 basis points. Bottom line, having been a mortgage advisor for the last 20 years, I'm always looking for ways to maximize your tax strategies, lower the amount of interest you pay, and deliver to you the right home loan product at the right price. If you're in the market to purchase a home, or you're even considering a cash-out refinance, give me a call at the office. I've done this for 20 years and have been blessed to have provided financing to over 25,000 families. I'd love to help you with your home financing options. Your dream home may already be within your reach.